Welcome to Chapter 2, Episode 2 of Financial Education for Pilots. In the previous episode, we discussed Employer-Based Retirement Program 401k. In this episode, we will look at Individual Retirement Accounts, or IRAs, Roth IRAs, and the Backdoor Roth IRA. All of these programs are independent of the company an individual works for. Disclaimer: the information provided in this video is meant for educational purposes. Please conduct your own research as to which plan is best for you and consider talking to a financial advisor. A traditional individual retirement account, or IRA, is a self-funded account to save money for retirement. This account allows an individual to save additional money aside from a 401k or pension and allow it to grow for when he or she retires. Similar to a traditional 401k, the money put into this account is pre-tax. When you file your taxes at the end of the year, any contribution made toward a traditional IRA will be tax deductible until you exceed a certain income threshold. Before we go in depth on IRAs, let's take a look at who is eligible for tax deductions. To start off, the baseline is calculated by your modified adjusted gross income. The number is calculated by determining your adjusted gross income for the year and adding certain figures back into it, like dividends, interest, tips, wages, and rental income. Once we have that number, we can figure out eligibility for tax deductions. For a traditional IRA, if you are filing single or head of household, you are eligible for full deductions up to your contribution limit if your MAGI was less than $66,000. If you made between $66,000 and $76,000, you can still enroll in a traditional IRA. However, you will only be able to have partial deductions. If you made more than $76,000, you can contribute to a traditional IRA. However, none of the contributions will be tax deductible. If your filing status is married filing jointly, your limits are slightly higher. If the MAGI was less than $105,000, you will be eligible for full deductions up to your contribution limit. If your MAGI was between $105,000 and $125,000, you're eligible for partial deduction. If you made more than $125,000, you can contribute to a traditional IRA. However, none of the contributions will be tax deductible. Since the money saved in a traditional IRA is pre-tax, you will pay taxes when you withdraw it. This is a simple yet important factor when individuals choose a traditional IRA account. As of 2021, IRAs have a maximum contribution limit each year of $6,000. If you are 50 or older, the maximum contribution limit increases to $7,000. The individual has the ability to invest the money however he or she desires and can be in stocks or bonds. A Roth IRA allows an individual to put after-tax dollars into the retirement account. In order to be eligible for a Roth IRA, individuals must make below a certain income level. For 2021, if you are filing as a single or head of household and make less than $125,000, you are eligible for the full contribution limit. If you make between $125,000 and $140,000, your contribution is reduced, and if you make above $140,000, you cannot contribute to a Roth IRA. If you are married and filing jointly, you can contribute a full amount if you made less than $198,000. If you made between $198,000 and $208,000, your contributions are reduced, and above $208,000, you cannot contribute to a Roth IRA. Because after-tax dollars are put into a Roth IRA account, you will not have to pay taxes when you withdraw the money in retirement. It is worth noting that an individual can have both a traditional and a Roth IRA. The individual is still subject to the maximum contribution limit of $6,000 or $7,000 between both accounts. Unlike a traditional IRA where your contributions are tax deductible, Roth IRA contributions are not. There are a few differences between traditional IRAs and Roth IRAs. First, traditional IRA accounts are subject to mandatory taxable withdrawals starting at age 72, whereas Roth IRAs do not have any mandatory withdrawals. Next, let's take a look at early withdrawals and how they compare. If you have a traditional IRA and withdraw money before you are 59 and a half, you will pay taxes and a 10% withdrawal penalty. For a Roth IRA, since the contributions were made with after-tax dollars, Early withdrawals up to your contribution limit are not subject to taxation or a penalty if you've contributed to a Roth IRA for the last 5 years. If you withdraw money that dips into the earnings or above your contribution limit, that may be subject to the 10% early withdrawal penalty. There are certain life situations that will allow you to withdraw early without any penalties. Roth IRAs allow you to save and take advantage of a lower tax bracket when you are beginning your flight career. For those reasons, there is significant value in starting a Roth IRA early and paying taxes now while you are in a lower tax bracket. There may be individuals who, because of their annual income, are not eligible to make contributions to a Roth IRA. Those individuals can take advantage of the Backdoor Roth IRA. There are different ways to contribute to the Backdoor Roth IRA. You can contribute money to a traditional IRA and roll over the funds to a Roth IRA account, keeping in mind you will have to pay taxes for that tax year. Another method is to make after-tax contributions to a 401k plan and rolling that over to a Roth IRA. Why would someone choose a Backdoor Roth IRA as opposed to a traditional IRA account? There are a few reasons. Roth IRAs do not have a required minimum distribution, meaning you can take as little or as much out whenever you want and leave the rest for your family for future use. Traditional IRAs require you to withdraw money starting at age 72. Another reason is that you will pay taxes now as opposed to later. This is vital if you think taxes will rise in the future or that your taxable income will be higher when you retire. Individual retirement accounts can be a strategic way for many individuals to put money aside for retirement. Taking advantage of the tax code early on for individuals beginning their flight career can prove to be tremendously beneficial years down the road.